What's up, everybody? My name is Joe Brown. This is the Heresy Financial Show, and today we are talking about the Reverse Repo Facility again. I've been getting tons of DMs and comments and messages from people about this recent article from Zero Hedge saying that the Fed is quietly handing out $250 million to a handful of recipients that are very happy because they're getting a ton of money, hundreds of millions of dollars, risk-free from the Fed just to park their cash in the Reverse Repo Facility. So in this video, I'm going to explain exactly what's going on. Ready? Let's dive in. All right, many of you have sent this article to me from Zero Hedge where they talked about the Reverse Repo Facility usage has just been exploding. Here's a chart of the actual facility. You can see that in March of last year, it started to get used and it's exploded in the amount of money that's inside of it, upwards of $2 trillion now inside the Reverse Repo Facility. Now, if you'll notice during this entire time here, it basically paid nothing. So there was not a whole lot of use for this Reverse Repo Facility, and then started to increase in usage. And the question is why? And now many people think the answer is, hey, well, it's because they're handing out free money, $250 million to a handful of happy recipients. I think there are 108 counterparties that are using the Reverse Repo Facility. And it's, in altogether $100 million every single day that's being paid out. So the question is, what the heck is going on here? Because it's by definition, like the only actual risk-free place to park your money is with somebody who's literally printing money and giving it to you just for keeping your dollars there. So what's going on here? Little bit of a background. I've explained this before, but the whole system is literally exactly like a pawn shop. Some banks at the end of the day have a lot of cash and they need collateral. Some banks at the end of the day have a lot of collateral, but they need cash. So at the end of the day, all these banks go to each other and a lot of banks will say, hey, I don't have enough cash. I've got a lot of treasuries or other collateral. Can anybody buy these treasuries from me so that I can get the cash that I need? Well, when Lehman went under, it was because all their collateral was mortgage-backed securities. They ran out of cash. They said, hey, we'll give somebody our collateral, our mortgage-backed securities. We'll sell it to you. And everybody said no. And so overnight, they were bankrupt. They didn't have cash. So that was an issue of bad collateral. So that was the repo market. Repo is repurchase because I'm going to sell you my mortgage-backed securities. You're going to give me cash for that sale. And I promise that at some point in the future, I will repurchase them. But all the other banks were like, no, because now we don't think that they're going to actually be able to repurchase them from us. We think that they're worthless, whatever. So we're not going to do business with you like that. So back in 2019, September of 2019, the repo market blew up again. And all the banks went to the repo market to say, hey, we need cash. But that time it wasn't an issue of bad collateral. That time it was an issue of just everybody needed cash at the same time. So everybody went all at the same time, said, hey, I need some cash. Can I give you some treasuries as collateral? But all the banks were doing that. So there wasn't enough cash. So the Federal Reserve stepped into the repo market and said, we'll give anybody the cash. So give us your treasuries, we'll give you the cash. So that was like a soft bailout that happened for the financial system in September of 2019. If we fast forward to March of 2021, we see the reverse repo market started to blow up. So what's the reverse repo market? Reverse repo is the opposite. They need collateral. They don't need cash. They've got an excess amount of cash, but they need collateral. Because if you remember, for a bank, a deposit is a liability. Because when you go to the bank, you give them $1, now they owe you $1. So that's a liability for them. So they need to go turn around and take that $1 and get collateral with it so that they have an asset to offset their liabilities on their balance sheet. Because if they just sit on a bunch of liabilities, then that's not good for them. So they need to go get assets, otherwise known as collateral. And usually this is going to be treasuries. So they needed a bunch of collateral. But if we take a look at the interest rates on short-term government debt, it was down in the dumps for a long time. And so all these banks had a bunch of cash. They needed to go get collateral for it. And if they went out and all got, for instance, these 3-month treasury bills, what would have happened to the interest rate? It would have gone negative because interest rates and prices of debt are inversely correlated. If you bid up the price of debt beyond the point at which it's paying you give back a positive rate, then that rate goes negative. If I borrow $100 from you and I owe you $101, it's a 1% interest rate. You sell that debt to somebody else for $102, I still only pay back $101. And so he paid $102 to get $101 back. That's a negative interest rate. And so if all that cash that entered the system when they printed all that money to deal with COVID, or deal with their lockdowns, if all of that money entered the system, went to the banks, got deposited, and then it went out to buy short-term debt like this, it would have pushed interest rates negative. The Fed can't have that because the dollar is the global reserve currency, and other currencies that were negative at the time rest on that. It would have blown up the entire financial system. So they said, we need to keep interest rates positive. So what did they do during that intermediary time? They told banks, you don't need collateral. Just keep the cash. We've removed the requirement on how much collateral you need to have on the other side of your balance sheet. Just keep the cash. Well, what changed? Right around this time, in April of 2021, they reinstated the need for collateral. They said, all right, banks, you need to get collateral again. But again, there wasn't enough in the system. So what did they do? They increased the interest rate on the reverse repo facility from 0 to 0.05. Let's take a look at interest rate at that time. I'm sorry, it was June, not April. From 0 to 0.05. So suddenly attracted a bunch of cash from the system into the reverse repo facility, because if you need collateral as a bank, now you don't have to go to other banks, you can go get it from the Federal Reserve. And so all that cash that was parked there started getting paid 0.05%, and everybody's happy, right? Well, why 0.05%? What was the federal funds rate at that time? The federal funds rate at that time was to 0.25%. They hadn't raised rates yet. And so the interest rate on the reverse repo facility was 5 basis points, 5 bips, 5% of 1% above the federal funds rate, just a little bit higher, so that it attracted some cash, so that all that cash didn't go to buy 3-month bills or, any short-term debt like that, so that that short-term debt stayed positive and didn't go negative, so that they could fulfill their capital requirements and make a nice little chunk of change there. So when you look at what's been going on recently, then we see the Federal Reserve raised the reverse repo rate from 0.05 to 0.3, and then from 0.3 to 0.8, and then 0.8 to 1.55, to the point where now 0.55, it amounts to over $100 million every single day. Interest payments parked with the Fed, risk-free counterparty. So why are they raising the rates on that in order to keep money in this reverse repo facility? Well, number one, we have to remember that this is still only 5 bips above the federal funds rate. The federal funds rate right now is 1.5 to 1.75. Every time they've raised interest rates, that target range for the federal funds rate, they have also raised the reverse repo facility rate so that it is 5 basis points above the bottom band of the federal funds target range. Right now, 1.5 to 1.75 is the Fed funds rate range, and so the reverse repo facility rate is 1.55. So they want to keep it just a tad bit over that bottom end of the range, so that that money stays in here. There's $2 trillion in there. So you could make the argument that yes, short-term debt this year has gone up in terms of how high the interest rate is on it, but not enough to attract that capital yet. Because if you make 1.66% on buying 3-month bills, there's risk with that, because what if interest rates go up again? Then the price of that bond goes down. It's inversely correlated. So you would much rather be getting paid 1.55% on something that doesn't have that market risk of moving up and down. So it's kept that $2 trillion in the reverse repo facility. Now you might be looking at this and thinking, well, that means they're paying risk-free. But yes, these banks would be getting all that money anyway, if not more right now. If those banks pulled the money out of the reverse repo facility and went and bought these T-bills, they'd be getting 1.66%. So they'd be getting a bigger return on their money if they went out into the marketplace. They're actually getting less. So this $100 million every single day, they're getting it from the Federal Reserve. But if they went out and bought bills, they'd be getting more than that from the federal government. And so really, it's not like they're making money hand over fist for nothing here. They're making less from the Fed than they would from the federal government. It's just doesn't have the risk of market fluctuation there. So they're making a lot of money. Banks are making a lot of money in the reverse repo facility, not as much as they could if they went out into the free market and took on a little bit more risk. The question still remains, why? What is the Federal Reserve gaining by keeping $2 trillion in here? The answer is they have some dry powder in the back so that when it really hits the fan, they can shove $2 trillion out there, because we know right now they're raising rates. That's forcing interest rates across the curve to go up. We know they're tightening. They're getting rid of assets off their balance sheets. Markets are collapsing. It is getting very painful for people. And so we know at some point they're going to look at this $2 trillion and they're going to say, the economy needs a stimulus, but we need to be able to prove to the American people that we can stick to our word. We told them we'd raise rates to fight inflation. We'll still raise rates. We told them we'd sell assets off our balance sheet to fight inflation. We'll still do that. But we think that the economy needs a little bit of a boost right now. So we're going to take this reverse repo facility rate, take it down from where it's at right now at 1.55, let's say just collapse it all the way to zero again. All this $2 trillion will rush out into the marketplace. A lot of it will buy this, a lot of it will buy other short-term debt, and it will go back out into the marketplace and provide a boost, a stimulus, ease debt conditions, ease liquidity conditions across the economy, and provide $2 trillion of stimulus there while the Fed gets to save face. And that's the key. They'll be pushing out all this money to have a little bit of a stimulus effect, but they'll still get to save face. They'll say, we're still fighting inflation, we're still tightening, while behind the scenes, they're easing conditions. So that is what's going on here. It's not that they want to give banks a free lunch, because banks are actually getting less money in the reverse repo facility than they would be if they pulled that money out and went out into the market. The only difference is they're getting it from the Fed, market risk free, instead of the federal government, which again, it's as long as you hold to maturity, it's still risk free because you're going to get that. The government is not going to default. So that's what's going on here. It's really just a secret weapon. The amount that they're paying is so that it's still in line with the federal funds rate, so that that money doesn't leave the reverse repo facility until they actually want it to, so they can continue to make conditions tighter until they can't anymore, save face, look like they're tightening while they're easing behind the scenes by draining the reverse repo facility. We'll see how long it lasts. I think the clock is ticking down here. It's a matter of probably months now. I would anticipate, and I've been saying this for about a year now, I would anticipate that by the end of this year, this reverse repo facility will be drained and back down to zero. Conditions will have flipped. They'll push all that money out. Yet to be determined. We shall see. As always, hopefully this helps. If you have any questions, leave them in the comments section below. And thank you so much for watching. Have a great day.